for BCom Honors, BCom General, CMA Inter and CA Inter students. Topic depreciation. Today I am going to discuss the seventh problem on depreciation. So join online class with Dr. Subrata Mukherjee. Cost of machinery in use with a firm on 1st April 2011 was rupees 3,75,000 and which the depreciation provision stood at rupees 1,50,000 on that date. The firm provided depreciation at 10% per annum on the diminishing value. On 31st December 2011, two machines costing rupees 37,500 and rupees 25,000 respectively, both purchased on 1st October 2008, had to be discarded because of damage and had to be replaced by two new machines costing rupees 56,250 and rupees 43,750 respectively. One of the discarded machines was sold for rupees 18,750. Against the other, it was expected that rupees 6,250 would be realized. So the relevant accounts in the ledger of the firm for the year ended 31st March 2012. This problem is very important, and in this problem you have to identify what is the amount of the written down value of the machine on 1st April 2011. Now there were two machines that were purchased on 1st October 2008. So I am writing here as M1 and M2, the two machines that were purchased on 1st October 2008, because these two machines were sold out on 31st December 2011. So you need to find out what is the written down value of these two machines on 1st April 2011. So the cost of the two machines that were purchased on 1st October 2008 was rupees 37,500 and 25,000. Now depreciation is charged on written down value method, and your accounting period is the financial year. So here the accounting period is from 1st April to 31st March, and the method of charging depreciation is written down value method. So the machine that were purchased on 1st October 2008, you need to charge depreciation on 31st March 2009. So this is the amount of depreciation at the rate of 10%. So this will be 1,875 and 1,250 because depreciation is charged for 6 months. So 37,500 into 10% into 6 by 12 will give you 1,875, and 25,000 into 10% into 6 by 12 will give you 1,250. So the 1st April 2009 written down value of machine 1 is 35,625 and 23,750. So on 31st March 2010, you need to charge depreciation at the rate of 10% on written down value method, that is 3,563 and 2,375. So the written down value on 1st April 2010 is rupees 32,062 and 21,375. So again on 31st March 2011, you need to charge depreciation at the rate of 10%. So 3,206 and 2,138. Now on 31st March 2011, it is given the cost of machine was 3,75,000 and the amount that was given in the provision for depreciation is rupees 1,50,000. So what is the value of machinery on 31st or 1st April 2011? You need to calculate. So 3,75,000 is the cost of the machine, against which the depreciation, against which the provision for depreciation was rupees 1,50,000. So 2,25,000 is the written down value of the machine on 1st April 2011. So from this 2,25,000, you have to reduce the written down value of the two machines that were going to sold on 31st December 2011. So this is 28,856 and 19,237. So again, I repeat, the written down value of the machine on 1st April 2011, is 3,75,000 minus 1,50,000 is 2,25,000. This is the written down value of the machine, of the entire machine. Now from this 2,25,000, you need to reduce the written down value of machine 1 and machine 2. So I am reducing here 28,856 and 19,237. So if you reduce these two figures from 2,25,000, you will get 1,76,907. So this is the written down value of the machine. I am writing here under M3. This is 1,76,907. So if you add these three values, that is 1,76,907, 19,237 and 28,856, you will get the written down value of the machine as on 1st April 2011, which is given in your question at rupees 2,25,000. So under M3, I am writing the balancing figure of the machinery that stood on 1st April 2011. Now, on 31st December 2011, the first two machines were sold out. So I need to charge depreciation on 31st December 2011. So you need to charge depreciation for 9 months. So 9-month depreciation on machinery 1 will 2,164, and on M2 this will be 1,143. So this is the depreciation for 9 months. So 26,692 and 17,794. So these two machines were sold for 18,750 and 6,250. So you have made a loss on sale of machine 1 for rupees 7,942 and 11,544. And on the same day, that is on 31st December 2011, two more machines were purchased. So I am writing here under M4 and M5. So the cost of the machine for M4 was rupees 56,250 and M5 was rupees 43,750. So you need to charge depreciation on 31st March 2012. So the first two machines were sold out. So you need to charge depreciation at the rate of 10% on M3, that is 17,691. And you need to charge depreciation for 3 months. So 56,250 into 10% into 3 by 12 you will get 1,406 and 1,094. So you need to charge depreciation on rupees 43,750 for 3 months. So the written down value on 1st April 2012 for M3 will be 1,59,216, 54,844 and 42,656. These are the written down value of machine 3, 4 and 5. Now let us prepare the ledgers. So first I will prepare the machinery account. machinery account. So it is given in the question that on 1st April 2011, the cost of the machine was rupees 3,75,000. So since a separate ledger is prepared for provision for depreciation, we are not going to charge depreciation in the machinery account. So on 31st December 2011, you have sold two machines. So by machinery disposal account. So by machinery disposal account. So what was the cost of machines that were sold? 37,500 plus 25,000. So 62,500 is the cost of machine that was sold on 31st December 2011. Now on the same day, you have purchased two new machines, so two bank account. So the cost of the two machine was rupees 1 lakh, that is 56,250 plus 43,750. So if you add up these two figures, you will get 1 lakh. So on 31st March 2012, the cost of machine was rupees 4,12,500. So this is the cost of machine on 31st March 2012. So 4,75,000. So the working of this problem is very important, and you will get all the figures that I am writing in the ledger in the workings. I will show you. So next ledger is the machinery disposal account. Machinery disposal account. So on 31st December 2011, I am transferring the balance from machinery account, so to machinery account, 62,500. Now these two machines were sold, so by bank. So what is the sale value of the machine? So if you add up 18,750 plus 6,250, you will get 25,000. What is the loss that you have incurred? So by PL account, so this is 7,942 plus 11,544. So the loss on sale of the two machine was rupees 19,486. So the balancing figure is the amount of depreciation that was written off and which is there in the provision for depreciation account. So this is rupees 18,014. I will show you how I arrived at 18,014. So you come to the working. So this is the amount of depreciation on M1 and M2, 1,875 plus 1250 plus 3563 plus 2375, 3206, 2138, 2164, 1443. So if you add up these 8 figures, you will get 18,014. So 1,875, 1250, 3563, 2375, 3206, 2138, 2164 and 1443. So if you add up these 8 figures, you will get 18,014. Now I will prepare the provision for depreciation account. Provision for depreciation account. So the cost of machine on 1st April 2011 is given as 3,75,000, and against this there was a balance in the provision for depreciation account for rupees 1,50,000. So I am writing here as 1,15,000. Now on 31st December 2011, two machines were discarded. So depreciation to be charged on the two discarded machine on 31st December 2011. So this is the amount 2164 plus 1443. So this is the amount of depreciation that was charged on 31st December 2011, that is 3,607. Now 31st December 2011, you need to transfer the balance to a machinery disposal account. So to provision for sorry. So on 31st December 2011, you need to transfer to machinery disposal account. So machinery disposal account for rupees 18,014. Now on 31st March 2012, you have charged depreciation on M3, M4 and M5 for rupees 20,191. That is 17,691 plus 1406. This is for your understanding. I am writing here. You need not to write the 17,691, 1406 and 1094. This is for your understanding. I am writing this, and the sum total of the depreciation on 31st March 2012 is 20,191. So what is the balancing figure on 31st March 2012 in the provision for depreciation account? So to balance CD. So what is the balancing figure? So if you add up the credit side, you will get 1,73,798. 1,73,798. So the balancing figure is 1,55,784. So you can cross check whether you have solved it correctly or not. So let us see. So the cost of the machine on 31st March 2012 is 4,12,500, and the provision for depreciation on this date is 1,55,784. So the written down value of the machine on 1st April 2012 was 2,56,716. So if you add up the written down value of the three machines, that is 1,59,216 plus 54,844 plus 42,656, you will get the same figure, 2,56,716. So you will get the same amount on 31st March 2012 or on 1st April 2012. So this is the entire solution I am showing you in one screen. So first is the working that I have prepared for the 5 machines, M1, M2, M3, M4 and M5. Here the machinery account, then the machinery disposal account and the provision for depreciation account. So you can cross check whether you have done it correctly or not. So the cost of machine on 31st March 2012 is 4,12,500, against which the provision for depreciation stood at 1,57,784. So the written down value is 2,56,716, and the total of the written down value of the three machines on 31st March 2012 is 1,59,216 plus 54,844 plus 42,856 is 2,56,716. Thank you. Thanks for watching the video. If you like the channel, then subscribe the channel to get regular updates